Hi, in this video, I'm going to tell you how to figure out how long your money is likely to last, which by the way might not be as long as many online calculators or financial advisors might lead you to believe. I will show you how to use the wealth simulation tool I built to manage my own wealth, and I'll walk you through it step by step to make sure you know how to use it. Finally, I'm going to answer a few questions that I've received from people like yourself that basically I think are worth covering, so make sure to stick around until the end. Hi, I'm Gary Mishers, Managing Partner and Chief Investment Officer of Silver Ring Value Partners. I also teach the Value Investing Seminar at the FW Olin Graduate School of Business. I get asked very frequently, how long will my money last? Or how much money do I need to retire? These are all basically the same questions because you're starting out with a lump sum or you're figuring out how much money you need and you have some assumptions you're going to make. So look, there's no way to definitively answer this, but we can approach this rigorously and take a little bit more of a sophisticated approach than some of the kind of first cut takes that we see other places. And I'll walk you through it. So let's dive in. So the first thing you want to really start with is what are your long-term rates of returns? So I'm going to switch here to show you my screen, and I have a couple of Excel spreadsheets I'm going to share with you. So bear with me here. So what you should be seeing here is a little model that I built just to show you the components of the long-term rates of return. Just keep in mind, look, I'm a fundamental value investor. I spend pretty much no time thinking about the market or long-term rates of return for the whole market. I spend all my time thinking about individual companies and investments. So with that in mind, this is not something I do every day, but if I had to answer this question of what would equity rates of returns look like for the next 30 years, this is one way to approach it. So I broke it down to four components, which are inflation, real GDP growth, dividend yield, and change in valuation. And those have been kind of, historical drivers of return. In the conclusion, I'll walk you through the reasons for the assumptions, but the conclusion of around 5% might surprise you because you might say, well, what about that famous 9 to 10% historical equity rate of return that I keep hearing about and I keep reading in the financial press? Well, this is part of the reason I'm spending time on this is that the current environment is very different than the last 80 to 100 years where we've gotten that 9 to 10% rate of return. So it's very important to understand those differences so that you might decide for yourself how conservative you want to be with your investments. So let's start at the top. So inflation historically has averaged around 3%. Currently, the financial markets are embedding inflation rates of 1.5 to 2%. And this is a recent number that essentially is built into the current bond structure of the US Treasuries. Next, a real GDP growth historically has averaged around 3%. And I think going forward, it's likely to be a bit lower. Again, I'm not an economist, nor do I spend a lot of time forecasting the economy, actually, none at all. But basically, if you were to think about it, productivity has, over the last decade, been lower than the past 100 years. We also are at a pretty high cyclical point in the economic cycle, which means that if we were to end the 30-year period, basically at a mid-cycle point, that would be a drag on GDP growth. Next, dividend yields have averaged 3 to 4% over the last century, but right now they're only 2%. So that's a negative in terms of current expected returns versus the past. And also, the market is more expensive than it has been in the past. The P, or price to earnings ratio for the market, is around 19 times earnings versus the historical average around 15 times. And if you assume that at the end of the 30-year period, we're back to the average, that again is a drag on returns. So if you were to build this up, you end up with a number that's slightly north of 5% for US equities. By the way, just to show you how it would have worked historically, you would have had 3% for inflation, 3% for real GDP, let's say 3% for dividend yield and no change in valuation, that would be 9. And then if you were starting the period where dividend yields were 4%, that would be 10. So, very important to keep in mind that these are different assumptions because we're in a different environment. So keep that in mind. Now, most people are not investing all their money just in equities, and they're frequently using what's called a 60-40 portfolio, which is 60% in stocks and 40% in bonds. So let's take a look at that. So here are the expected returns for the 60-40 portfolio. So U.S. bonds over the long term are currently promising around 2.5%. And U.S. stocks, as we talked about, are promising around 5%, slightly north of that. If you blend that together, you get around 4% for your total portfolio, which is, by the way, if you have all your money in a tax-exempt fund like an IRA or 401k. By the way, if you have some of the money in a taxable account, the after-tax returns are likely to be lower. So just keep that in mind. So let's switch to the wealth simulation tool and show you where this all comes in. So here's our annual rate of return, this 4%. And then we have a few other assumptions. We'll talk about that. And I guess one of the things I want to address is you have this quote unquote safe withdrawal rate, and frequently it's quoted as 4%. And that's a number that people frequently talk about as you can take out 4% of your portfolio every year without diminishing the portfolio. So I'm going to show you that that's not really the case anymore in this environment, just to caution you, at least according to my assumptions. But if you disagree and if you have different return assumptions or something like that, hey, listen, you can get the tool. I'm making it available for free. It's just something that I use and I'm sharing it with you guys to help you out. Look in the description and request it, and I'll send it to you. And you can put it in your own assumptions and play around with it however you want. So let's talk about a few other things that are important. So what's this number here, this 12%? Well, one of the flaws that many online calculators have is that they assume that whatever average return you have, that's the return you're going to get every single year. Well, that's just not how it works, right? So it'd be nice if every year you got your average return, but unfortunately, you're going to have years with much lower returns than your average and perhaps negative. And you're also going to have years much better than the average. Now, the sequence matters, and it matters a lot because if you start out with a few years where you have much lower than average rates of return, that actually really hurts your chances of being able to have your money last the whole period. And we'll talk about that. And that's a real danger, right? And it's a real danger now because, again, I spend no time timing the market. I'm a bottom-up value investor, but this is a dangerous point in the market. Valuations are high, sentiment is high, and it would not be crazy to have the stock markets have not particularly high rates of return or below average rates of return in the next few years. They might not, I have no idea, but if you want to be conservative, that's something to keep in mind that can happen. So let's talk about where this number comes from. Well, bonds had historical annual standard deviation returns of mid-single digits, and stocks have had standard deviation returns in the high teens. So if you blend it together for that 60-40 portfolio of 60% stocks and 40% bonds, that's where that 12% number comes from. So if you're using a different blend of assets, again, if you download the wealth simulation tool, you're welcome to play around with your own assumptions. So now, what is a Monte Carlo simulation? It sounds like a fancy term, and I always hate jargon. So all it is it's a way to repeat the same statistical process over and over again. So you're drawing from the same distribution of returns, and you're basically getting different outcomes, right? So for instance, here you have one possible distribution of returns, and that averages out to around 4%. If you recalculate it, you're going to get a different number. So you can keep recalculating it, and look at this. We recalculated from the same distribution, and all of a sudden, instead of our money lasting us 30 years, we run out of money at the year 21. So if you were to click this button, however many times you put in, the simulation will run, and in the output tab, you will see the results. I'm not going to click it now because it takes a few minutes to run, but I did this already prior to starting the video. So let's take a look with these assumptions, what happens. And what happens is this chart right here. So what does it mean? It means that about a quarter of the time, so 24%, but let's just call it a quarter for round numbers, you're going to run out of money with these assumptions prior to your 30-year goal. And that's important. So 1 in 4 times you're going to run out of money. Now, if you have other sources or other ways to replenish your money, that's fine. But let's say if at that point you're, I don't know, 90 and maybe you don't have anyone else who can help you out, that's a problem, right? So this, how to use this is up to you, and how conservative as an investor you want to be is up to you, but this at least gives you a sense of how likely you are to run out of money. So let's talk about a couple of questions that I've gotten about this tool from people like yourself. One question I frequently get is, well, what about other sources of income, Gary? I have not just my assets, but I have, let's say, a pension plan. Well, let's say you instead of having to use just these assets, this $10 million to retire on, you also have a $200,000 pension. And let's say it's indexed to inflation, just to keep things simple. Well, that might mean that instead of 4% here, you might put 2% here. And that number will make it much less likely that you run out of money, because now you're only withdrawing 2% a year from your portfolio instead of 4%. People have also asked, what about inflation? Well, inflation is built into the annual rates of return because it's a component of returns, as we talked about. But let's say if you expect your expenses to grow at an inflation rate that's higher than the general inflation, you might choose to reduce this rate of return by the difference. So let's say you think you're going to have a 4% rate of inflation for your expenses. That means you might reduce your annual rate of return by the difference between 4% and 1.8, which is the inflation component they have built in to the returns. So again, a couple of ways to handle common issues. This is not a tool that I'm selling or anything like that. So there's no bells and whistles. This is something I really do use for planning my own financial future and that of my family, and I'm just making it available to you guys for free if you choose to play around with different assumptions to help you guys figure out your own financial plan, and you can request it by clicking the link in the description. So what are you to do? So if the answer is that you might run out of money sooner than you expect, what's the solution? Well, there are three possible answers. The first answer is you might start with a higher amount of money. You might say, well, how am I going to do that? Well, one common answer is rather than retiring at a certain age, you might wait a few years and build up a bigger cushion to reduce the possibility of running out of money. That's one way to handle it. Another is to live on less, right? Reduce your expenses. So if instead of needing $400,000 a year, you're okay living on $300,000 a year, that will make it more likely that your money will last you the whole period of time. Finally, the last answer is to get a higher rate of return. That's actually the most difficult, in my view. And why is that? You might say, well, why don't I just do better than the market? Well, it's hard, right? Many people try and most do not succeed. And how might you do better than the market? One way is to invest directly in securities, and the vast majority of people maybe just don't have the training, the temperament, the time to do this well, and many people will end up with actually below average returns while trying to beat the market. Well, let's say that, say, fine, Gary, I'm going to pick a professional and I'm going to basically use a mutual fund to do better than the market. Well, first of all, you should know that vast majority, over 80% of mutual funds do worse than the market. That's one statistic you should be aware of, the base rate probability. But also, you should ask yourself, do you have the process to pick a mutual fund manager or a manager of any sort, or investment manager, who is likely to do better in the market? Because many people use this very simplistic approach of, let me find who has done well last year or the last 3 years, and I'm going to invest with that manager. And unfortunately, it's not their fault, by the way. I think it's the fault of the industry, because the mutual fund industry, on average, is very cynical, and they take these statistical, historical returns, which have no statistical significance. They have no predictive power whatsoever, how you did last year or how investor did over the last 3 years, and they market the heck out of them because it's profitable. It sells funds, right? They're not trying to figure out what's best for their clients necessarily. I think some are, but as a whole, I think there are plenty of firms that are essentially all they're doing is just trying to grow their assets as quickly as they can. And if they have 100 funds that they launch, they're going to market the 10 funds that have good results over the last 3 years. And if people buy that, heck, works for them, right? But so don't fall for that. That's just not the way to pick winners. And people who try to do it that way end up doing, on average, worse than the market. So what is a good way? If you're able to actually assess the process, the investment process of a manager, that is something that you could use to figure out who might beat the market. And that's still hard, but I think at least you have a fighting chance. And fortunately, it's a very small subset of people who have the ability to do that. And if you're not one of those, then I think a low-cost index fund from an incredible firm like Vanguard, where they're not trying to make profits from you, they're just trying to cover their costs and do a good job, might be the best solution for you. So hopefully you found this video useful and are more knowledgeable about how to plan your financial future and what is reasonable to expect for how long your money might last. If you like this video, please like this video and click like, and also subscribe to my channel below to get notified when new content becomes available, which will be on a regular basis. Finally, please ask your questions in the comments below, and I'll make sure to get to them all. And if some occur frequently, I'll make a new video out of them. And thank you for watching, and keep up the good work increasing your investing knowledge. Take care.